All right, so we have an old low here, relative equal highs. The market trades above that, then breaks down and takes out the sell side here. What does that make this range here to here? A dealing range. Now, how is that useful? Well, we're in a very long, protracted consolidation. It wasn't like a short little run from here to here. It was elongated. This is a daily chart. So this is a lot of time going sideways, essentially. But it took buy side and then eventually aimed for sell side. So the dealing range high, dealing range low. Why is that a dealing range again? We took both sides, buy side and sell side out. What's the bias now? Bearish. All of this range in here, we're looking for areas that anticipate a run back up into a premium. Short-term high, short-term low, it runs up into a premium here, it sells off. It creates relative equal highs. Sell side's taken here. So once it has taken the sell side here, what's the market likely to do? Revert back to buy side. Even though it's bearish, where's the buy side? Like a neon sign, relative equal highs. Bumps up to it, then does what? You have now a new dealing range. You have a dealing range from low, because it took out the sell side, and the buy side's taken here. So your dealing range is from here to here. What is the usefulness in that? You're anticipating the market to trade back down to a discount and eventually to its sell side. Discount array below 50% of here to here. This fair value gap is a target. So you're going to be looking for areas once it sells off. Here's a fair value gap. Break lower, target, filled, sell side, relative equal lows, tags it. So now we have this dealing range from here to here. Why is that a dealing range? We've taken buy side here and sell side's been taken here. So from here to here, you start doing analysis inside of that range. Look at all the back and forth in here. And then we get to this level here and it's more energetic. When I see that, I identify this as the dealing range high to here, but I will refine it down to the most energetic price swing inside of the dealing range. So I'm going to use this range here from high to low. How's that useful? From here to here, I'm going to be looking for a equilibrium price point or premium to go short, because the bias is what? Bearish. I publicly made that known even on YouTube. I said we're entering a seasonal tendency here where we go into May where it's bearish. Did it deliver? Of course it did. Now, this gap here, we see it trade up into it here. Sells off, comes up into it here, fails to go into it there. But look at all these opportunities where it could have filled in that gap, but it didn't. Broke lower. That indicates to me that this is a breakaway gap. I will talk about gaps in its own topical study, but for now, this is a breakaway gap, meaning it's going to most likely stay heavy and run where? In our bias. What's that direction? Lower. So we have sell side below here now. So we expect market's price to trade lower below that. It does so, and then keeps on trading lower and creates a short-term low here. Rallies back up into a gap. Drops down once more. Takes sell side. So now buy side is where it's likely to revert back to. And from this high to that low, that's our focal point for our study. So inside this range, I want you to think about what you see. All right, so I have the chart kind of aligned so that we can focus on that range here. So inside that range, again from here to here, we have a buy side liquidity pool right there. It trades up and purges buy side. Why is that likely to occur? Because we're bearish. We're going into a seasonal tendency where the market's likely to trade lower. So anytime it runs back above buy side liquidity, it's likely to sell off. Once it accumulates those buy orders, it's going to target what? The sell side below that low here. And it does so here. So sell side is now purged. So in short, if we're bearish, I like to look for a short-term high taken out and accumulate short positions. Who's accumulating short positions above old highs? Smart money. They held price there. Why? Because they were allowing traders to engage this as what? A bull flag. Retail sees that. Oh, look at this doji down here. It ran up. Support is now being found here because that was resistance. And that is now what? A continuation of a buy side run higher with a bull flag. it's going to run for this area here because that's resistance. And the opposite took place. We were bearish here. The market trades lower, attacks the sell side, runs in, spends time down here, and then we have Friday's price movement. So let's discuss liquidity a little bit deeper. What I'm about to show you, this is it. We have now a dealing range. This low was taken out here. This high was taken out here. So now we have this high down to that low. How is that useful? Well, if we strip this away, I want you to think about the simplest of things that retail traders use. And I started this way, same way in 1992, folks. The same procedure of looking for classic support and resistance. So we're looking inside this range here. Okay, this is our specific dealing range. What do you see? Before I go further, wait a minute, ICT, you just said that's a dealing range. Right. These are relative equal highs. It went above into the fair value gap with this here. And we never were able to go higher. So I'm looking at that as that's the cap on the marketplace. And it's likely going to be a breakaway gap. That means it doesn't fill right away until it fulfills lower level objectives on price down here. So what do you see in here? All right, so we have this high to that low. Why am I picking this high? Because it has the most energetic price run away from it. It's the most recent one that has that energy going lower. The delivery of the candles moving away from it quickly. That's what I'm really getting at. So I'm framing it with the logic that this is likely to stay open, not rebalance, and the market's going to drive lower. So our range from here to here, that's what I'm measuring, and equilibrium is here. So above that level, this level here, what are we looking for? Well, we're looking for buy side. But classic support and resistance idea is this. We've taken out this low, relative equal lows. Okay. This break below it here is shallow and it's short-lived. And then we broke down aggressively through it. So classic support and resistance traders are going to do what? What are they going to be thinking about that low once it broke through it here more meaningfully? They're going to assume that that was support broken, now turn what? Resistance, right? So they would expect price to trade up into that level right here and then trade down from there. Not understanding any of the logic as to why it would do this at all. That's narrative. That's the reason why retail traders suck. Because they just simply look for support and resistance, or they look for patterns for pattern's sake, and they're fooled by randomness. The algorithm is not random. So I teach you to look at a range and define it in the scope of premium to discount. Equilibrium is here, and if we're bearish, we need the price to get to equilibrium or preferably higher than to go short. In this shaded area here, why did it not just simply trade back to that low and go lower? Why didn't it do that? Think. That's our last up close candle right before the energetic move lower. Inside the context that this is likely a fair value gap that is going to stay open. Why? Because it had no ability to get up until it closed it at all. So that changes the fair value gap to what? A breakaway gap. Breakaway gaps remain open until lower level objectives are fulfilled and delivered and booked. In other words, it goes lower to a specific price level in the discount. Then at a later time, it might come back up to here, but it could be an undetermined amount of time. I don't know when they'll come back to fill in a breakaway gap. And if it's bullish market, everything I just said, just reverse it. This last up close candle prior to the move lower and taking out that dealing range low, that is my ICT bearish order block. It trades lower, comes back up, doesn't really quite get back to that old low, sells off again, then it comes back, ramrods this low here, goes above it, and then consolidates. So anyone that would have expected this little bit of fluctuation through, this would have wore them out. These are days. These are days of trading, S&P. Shorts are going to be scared. It's probably going to go higher. Why? Because they see a bull flag. Run up, consolidation, and they expect it to go higher. We're bearish. We're in a premium market, and it's going to a bearish order block. Now, price is likely to drop lower and reprice and target what? What's it going to target? If this is your trade, what's it targeting? Well, think about what I taught on this YouTube channel, flagship pattern, the optimal trade entry. From high to low, 79%, 62% retracement levels. That's here. That's my optimal trade entry. So you can use targeting approaches where you put the fib on the bodies here and here, the lowest of the open or close and the highest of the open or close, and your projections down would be right in here. And I'll leave that for you to study and do it on your own. But we have a fair value gap that's left open, bearish order block, a dealing range that's been broken to the downside. The only thing we've done is retrace back into a short-term premium, and retail traders are going to see a bull flag. We're looking at it to go lower. What's it going to go lower for? Before we get into that, we have a short-term low that's taken here. So we had sell side here, and it starts to rally back up. What's it reaching for next? It's going to revert back to buy side. That's this here. That's why it's not going to go to simply that level and go lower. It's going to go deeper then to clear off all the buy side liquidity, so that way it can absorb that buying orders and translate that to a short position for smart money. So the counterparty is the buy side being attacked here. So shorts in the smart money camp can then target that low down here. So we have buy side taken here. The sell side was taken here. So now the sell side changes to here, because the dealing range is now defined by this low and this high, because buy side was taken on this high, sell side was taken on this low here. So we have a dealing range here. How do we find that useful? We're bearish. So even though this is a fair value gap close to around the equilibrium between this low and this high, that simply would just be a partial. And we hold for what? Sell side to be attacked. But look closer in here. What do you see? Let's zoom in. So here is that area here. And inside this own area of shadedness, I've taken your attention to this short-term low here. So we have a short-term low here, and then it gets taken out, and then we have this low here, and it starts to rally up. Look close. Do you see that this is a swing low? Again, these are daily candles. They're not lower intraday charts. We have a low that takes out sell side here. Runs down, creates that low. One more smaller attempt to go lower than this day. It does. Then the following day, we open, trade down, and trade back up. This is a swing low on a daily chart. After we've taken out sell side below here, and we have a short-term sell side liquidity pool here, which it runs down into, and then creates a swing low. So we're in a discount inside of a discount. Think about that now. If sell side's been taken here, and sell side's been taken here, what's it going to revert back to? Buy side. Where's that? Swing high on the daily is here. So if it's going to go here and run to that level, buy side is simply not just that at that level. What's above that? Bingo. Our gap. We've been talking about that gap for a couple weeks now. The easy low-hanging fruit objective, 38.80, I gave that on Twitter, and I'll talk about that in a couple minutes. But notice how we had sell side taken here, and then the market reverts back to buy side and to an imbalance, that gap. Large range day. Well, how did we know, or how could we have known, that Friday was going to be a large range day with an up movement? Well, let's dig into that now. All right, so we finally made our way down into the hourly chart for S&P. Here's our gap from the daily chart that's noted here. And here's that old sell side liquidity pool. And we dug down into that. And I'm going to add some day dividers here so that we can get a little bit of context. I want you to look at the profile of the week. Okay, now when I say profile, that is not volume profile. Okay, I do not use volume profile. I do not use footprint. I do not use depth of market. They are all gimmicks. And I know that's going to upset some of your followers that use that stuff. Okay, I promise you the market's not moving and booking based on those interpretations. It's simply not. Okay. What I'm about to show you, this is it. This is what makes the market do what it does. Okay. This is how price books. I'll leave it up to you to wrestle with it, but I'm the one making money with these trades, and you're over there putting things on your charts, looking at those things and not price action. You're not even relating to how the market is going to deliver on a weekly profile. Weekly profiles are a template. Okay, how should price deliver? I want to walk you through this one here and how I was able to tell you before the fact on Friday that we would see 38.80. So on Monday, we opened from all of this nastiness here on the previous week. The market starts right away on Monday, just starting to go higher, repricing, going higher. No one can go short, no one can go long because it's just constantly just going higher. If you fight that, you're dead. You got to wait for some kind of displacement. When does that occur? On Tuesday, we have a little bit of a movement here and then breaks down. Then sell side is taken, and think about what I showed you on that daily chart. We now have a swing low. So on Thursday, we can anticipate the market doing what? Coming back down to a discount, rallying up, and right about here, that's what I said, weekly objective on Twitter is 38.80. Now, why did I pick that? I'll tell you in a moment. But Friday, notice what we have here. The market's already moved above all the consolidation here. It's not likely to do what? Have a sharp movement lower. It's not going to take sell side out because it's already done so here in the consolidation. It's already worked into this fair value gap here twice with a sell stop run there, taken out here, digging deeper into this imbalance, leaving the bottom portion of that imbalance open, making it what? A breakaway gap. So it's indicating that it's not likely to have retracements of any magnitude that would see this revisited again. So we had this level taken out here, retraces back down into a short-term discount from low to high, fair value gap, digs into this here, and then once more on Thursday, it rallies, comes back down in, retraces, and this is where I'll talk about what I was wrong about on Thursday, but right about the second part of the day. But Friday, we just started consolidating, had a little bit of a movement on a lower time frame in London, which I'll show you, and then off to the races because the market only had Friday to fulfill a run into that gap. Everybody knew about this gap. Nobody knew when it was going to hit it until around Thursday. And that's kind of like what I was hinting at on Thursday's trading. So on Thursday, I was looking for a run into this level here. And initially, I was wrong. And I took a trade and got stopped out plus 2 points. And while it wasn't a loss, I was incorrect about it running to here. But what I was expecting was, and I mentioned this on Twitter, I was looking for a run up into here and then trade back down in. And I think I did this discussion on the video on this YouTube channel also prior to this video. So I don't know what date that was or what the title was, but just take my word for it. I covered this and talk about what I was looking for and why. But I wanted to see this level taken out here and then drop down into that to be a long and then look for higher prices. It did that, but it didn't give me the run first here, then drop down because I wanted to see this high taken out. I was going to go short there after long. So I was longing, shorting, reversing it, writing it down here. I was going to go long there and then hold for 38.80. That was my plan for the week. That's the video I wanted to talk about like right now. That was what I wanted to cover on Friday as a review, saying this is what I did and how I did it and why I did it. But it denied me that run here. But that's fine. This level here, I got in sync with the marketplace, made some cash, and then on Friday did it again as well. This imbalance right there, that's what I used to justify the run up into 38.50, and there's two setups that were made available if you were looking for it too, and we'll cover that now. 38.80, this was the tweet. You can see the time on the 23rd, so right in here, right about in there. And the market consolidated. So because it's consolidating, I don't expect it to drop down because everybody wants it to go oversold. They want to see some kind of harmonic pattern, a Gartley, a bullish, divergence in some indicators, something to that effect. When the market's this close to the gap or some premium array, and you only have that day before the week closes, when everybody with any insight would know that this is where it's drawing back up into, because it's a gap. It's a real gap. Actual gaps have a tendency of filling in, and it's an obvious target. So I know some of you hardliners in here that are very critical of me. Oh, everybody does this. Everybody does that. Okay, well, post your trade. Post that you knew about it beforehand. You outlined it beforehand, and you actually traded it, because I already done that. All right, we're going to drop down into a 15-minute time frame. You can see the fair value gap here. We dropped down into it in London, consolidated into another run into that fair value gap in London, and then aggressive run right at the 9 o'clock hour. Market was not going to give anybody an opportunity to see a deeper retracement. And inside this run, I'll show you what it looked like also, but this is the low-hanging fruit objective. This is what I tweeted. This is what I posted on Twitter the day before. Said we would look for 38.80. Why is that low-hanging fruit? Low-hanging fruit is the easy objective. This is how I teach my students. Now, obviously the gap being closed entirely would be up here. Well, it may not have done that on Friday. We only had just Friday to get up to this level. It may have just fell short of it. So the low end of the fair value gap is down here. So what's the nice round 10 level into the gap? The first one, 38.80. That's why I elected to use 38.80. Okay, so that way you know it wasn't just some random number. I told you the logic here as to how I used it and determined it. Right away into the 1 minute chart. You can see at the New York session at 9:30 equities opening, we see a run aggressively here. Fair value gap. It drops down into it. Buying opportunity if you were trading with the New York 9:30 opening and the target, that gap, the shaded area up here, you could be a buyer here. The market rallies up, creates another fair value gap there. Again, thinking about that weekly profile, don't expect it to retrace. Don't expect it to have any kind of movement lower. It's in a hurry, folks. It's been stagnant most of the week, waiting for price to show a willingness to want to go higher. Once it showed that, it wasn't coming back to old resistance, broken turn support. Think about what I showed on the hourly chart. Rewind the video back to the hourly. You can see how the market did not, once it broke above, it did not come back down to what logical support level would be seen with retail, seeing old highs broken. Let's wait for it to come back and touch it again. That doesn't work, folks. It's not when you have time crunched like it is here. Friday was the day of delivery. Thursday in the evening, 1 minute after 11, my local time, Eastern time in the United States, I said 38.80 is the next draw, and that's my weekly objective. Making it public, that way you know, there it is. And here's where it went to.